Welcome back. This is Raise Your Average. We are excited to have Aahan Menon on the show today. Aahan is the founder and CEO of Prometheus Research, a pioneering firm dedicated to democratizing access to elite financial research. With a background in both institutional and retail investment research, Aahan brings a unique and well-rounded perspective on macroeconomics and markets. His work at Prometheus focuses on leveraging systematic data-driven frameworks to provide real-time insights into the economy and markets, helping investors navigate complex economic cycles with confidence.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Welcome, Aahan. It is great to have you back and to kick off 2025 with you.
Pierre, I'm really excited to be here. Thank you guys for having me on.
Mike, it's great to see you as well. Happy New Year to you both.
Mike, great to see you as well.
Great to be seeing guys, as with you. I'm looking forward to today's conversation. I think Aahan's got some of the sort of deepest knowledge base across sort of the dynamics that work in economics and rates and how they sort of translate into actual positions in asset classes. So I am really excited to dig into the framework over at Prometheus, maybe as a quick reminder as to how he thinks through things. And it's a probabilistic framework. It's not zeros and ones. It's not all or none either way.
Yeah.
And just walk us through what we're thinking for 2025 and where we might have opportunities and where the opportunities might be overestimated by the market.
2024 was kind of a wild and tricky year, right? I mean, stocks are continuing to skirt all-time highs. That makes it a little testy. Valuations are stretchy. Long bond yields, the 10-year, closing in on 4.7%, despite the Fed's rate cutting activity. We've got an environment of increased volatility across rate, equity, and credit markets. Aahan, what do you make of it all?
A lot wrapped into one question here.
Anywhere you want. Begin anywhere you like.
Well, I think it would be good to start with that framework that we outlined a little bit. Just help people, because you're going to go through lots of stuff, lots of data that you have on that you guys have compiled. But I think it might make sense to just think through the different dynamics that you're sourcing that information from and then making conclusions about asset allocations and things like that.
Yeah, sure. So maybe we start with framework and then I can frame up the context. So I think the presentation that, your viewers are going to either watch or listen to, it's basically, I think one of the things that we've tried really hard to do is to make all of our research analysis is not random piece of information. It's meant to stitch together to create one cohesive kind of outlook, which gets reflected in systematic portfolios. There are basically two big categories in terms of how we think about allocating across macro markets. And it's based on one, which way do we think the economy is headed? And two, what are the attractive bets available in markets? So one is basically trying to understand which way growth, inflation, and liquidity, because those are the big drivers. Which way are those things going to be headed generally? We have now costs and forecasts and things like that help us get a rough sense of what the prospective trajectory for these things are over a month to maybe 6 months, depending on variable. On the market side, we try to look at two big silos, I would say. We try to look at one, what is currently discounted into markets. To generate any alpha in markets, you have to have a view that is not already reflected. So what we try to do is assess what is discounted into markets relative to our fundamental expectations, and does that create an attractive risk reward opportunity? So are we going to bet against what's priced into markets today, and is that going to be attractive? That's one pillar we look at within the market segment. The second pillar we look at is something that we started doing about 4 years ago, actually, when I started Prometheus. This was the foundation of Prometheus, really, is what we call market regime probabilities. And what we're really doing over there is we're going across macro markets and looking at all the different configurations of macro market price movements to figure out what they are telling us in unison about the economic environment. So what are the probabilities of rising growth? What are the probabilities of falling growth, inflation, and liquidity? Adding those two relatively opposite views on markets lets us be both modestly pro-cyclical and modestly counter-cyclical in a way that we think is balanced, and adding both the market dimension and then the fundamental dimension gives us our comprehensive picture, which is reflected in our positions. So that's basically how we come at it. The slides are basically going to walk through, everything that I described piece by piece. With regards to where we are today and what's happening, I think the volatility that you're seeing across markets over the last year. So what's happened over the last year? Let's start there. Basically, we entered 24 with markets generally enter 24 with an expectation of some type of recessionary event. So you look at short rate pricing, you look at what was happening with earnings expectations at the time, all of those types of things. You were expecting, markets were generally expecting a slower macro backdrop. But relative to that macro backdrop, that expected macro backdrop, conditions were generally good. And so all of the expectations that were baked into policy rates and all the expectations that were initially baked into equity markets just ended up getting priced out. And so equities rallied a lot and bonds sold off a lot. They caught a little bit of a bid around mid-year and then began to sell off again. And so now we're at this point where the economy is still fine by, a broad array of measures. But we now have a fixed income market that's basically pricing about one cut, and we have equity markets that are pricing relatively strong earnings over the next year. And so the expectations over the last year have flipped, even though by any stretch of the imagination, the people always expect price data to look consistent with what happened to the economy. Not much happened to the economy. The economy was basically fine, and markets were priced very differently from what was going to happen to the economy, and that's what gave us the market reaction we got over 24.
Yeah, an up 30% year was something that's I think was not an expectation of many folks in January of 2024.
Yeah,
and certainly growth delivered. I think there's multiple expansion in there too, and we saw several attempts too to sort of try to broaden out the market, which seemed to fail. Continuously, whether you look at equal weight versus market cap or getting down into small mid cap type stuff, it seemed to always come back to the mega caps driven by, whether it's AI and their ability to create those earnings, because their earnings are robust and have had some significant growth and dominate the market cap weighted indices from the standpoint of the exposure of those indices to those large mega cap companies. So lots of things to balance for advisors and allocators, especially those who are trying to think through diversification as a key point of differentiation or risk management in a portfolio, where diversification yet again has been something that has not paid.
Yeah. Mm-hmm. Like last year at this time, at least like looking back at what was happening, it was very suspenseful. Like this. There was so much suspense at the beginning of last year, at least for the first quarter, if not the second, until the Fed started to actually talk about cutting. And I think Bank of Canada was the first to move, at least in North America, and that sort of started to set the tone for the second half of the year. But that first half of last year, the first half of last year was, in my memory, it was a very, very difficult time to read the market, extremely difficult to decide like which direction. We had that sort of catalyst in the bond market at the end of 23. One of the most notable things that I heard was from Earl Davis at BMO, basically saying that, the market's reaction at the end of 23 was to, test 10-year treasuries down to 3.5. And that once the market had done that, the focus would change back to what's going on with the economy, what's going on with spending, deficit, all that stuff, and inflation, and that it was very likely that the bond market would test upwards, would start to test back into the 4.7 to 5% range. And the funny thing is that it actually that forecast on rates, on yields, came true.
I think it was, it's also a very, I'm not familiar with the forecast, but
Yeah.
kudos on. But I think a very interesting thing is that almost virtually every cutting cycle in history that we have is just an amazing environment for bonds usually. Because the cutting is usually in response to some type of adverse economic outcome. So I believe since 1965, we've had about 9 cutting cycles. At least 8 of them are in response to a very material deterioration in the economy. And so what ends up happening is even if cuts are priced, the cuts delivered end up being further than what's already priced into the market. And as a result, every cutting cycle has been just a standout and stellar period for bonds. Today, we have a pretty different kind of thing. And I think what really happened in November and December of 23 was with what was this, Powell Pivot 8.0? With this sort of pivot type of thing to a cutting cycle, I think the expectation was that we're going to have that again. But I think that it wasn't adequately reconciled versus what was the likely path of the economy. So we had this crazy rally where we baked in about 8 interest rate cuts, which by all measures in history is entirely consistent with the recession. And we had
Recession.
GDP data, nominal running at 5, 6. We had reals at 3, 4. And I think that has been the really hard thing to trade, right? Like that has been the really hard thing to trade unless you're pretty in the weeds of like what's priced in the bond markets, how does that make sense in history, what drives that pricing, and that kind of understanding. So I think that's really, and that pricing, I think one thing that's very underrepresented is that pricing flows through to equities too.
Yeah.
Because equity is like any asset, right? They are a series of discounted cash flows. And if you change the discount factor, the price of the equity is also changed. The thing that's really remarkable, is that equity markets have had, despite going through an effective tightening through this discount rate expectation, the growth expectations that powered this tightening of interest rates has just outshone any, increase in discount rate. So equity markets, the performance of equity markets is definitely been remarkable over the last year.
And so, you're proposing that is actually, in fact, due to the robust growth that's occurring
Yes.
in earnings across there. So you are, and I do agree, because you do see that in the expectations for earnings going forward.
Mm-hmm.
They're pretty robust. And we'd be remiss not to talk about, was it December 18th? And so I want to talk about how your models responded to that sort of quantum day of that was a very large outlier example of a price action across a broad array of asset classes, which were changes in expectations, which I know is one of the sort of the legs of the stool that you look at. So I want to make sure we come back around to that whenever you think it's appropriate to do so, as we think through inflation, growth, liquidity, and how they're mapping together.
We're going to offer basically 2 perspectives on macro data. We're going to offer basically high level. We have our own proprietary gauges we put together that we expect to have a modest lead on growth, inflation, and liquidity conditions. And so that just kind of helps you broad strokes set the table. From there, I think we can move into kind of, I think the main thing that we really think is going to change in 25 is going to be that growth is going to be weaker than expectations. And we can walk through, we have a lot of kind of granular data in terms of why we think that is. So maybe just to set the stage for the big macro variables first. Here we're showing our Prometheus growth gauge. We basically take hundreds of economic data series across a variety of time dimensions and aggregate them up nicely to give us something that has a modest lead on what's happening to realized GDP growth. So what we visualized, over here is in the blue line we have in the blue line we have our growth gauge, and in the red line we have the Atlanta Fed GDP nowcast. We've done a back extension using realized GDP data because the Atlanta Fed nowcast is only available since the mid 2000s. And as you can see, like this growth gauge has done a pretty good job of kind of anticipating what the major inflection points in GDP is going to be. So where's that reading at today? We basically see an environment where you're probably going to have slowing of the economy. So when our growth gauge gets into kind of like the negative 50%, so the scale is -1 to +1. So if we have a negative 50% reading, that's usually a recessionary reading, for just based on history and the way the data sort of fits. But where we're at today is, just low negative readings. And so what we expect that to translate into is a slowing pressure, which could have a little bit of contractions along the way. We'll show later how that's translated into a forecast, but that's basically broad strokes, which way we think the growth is going to be headed. Much like our growth gauge, we take a lot of data, aggregate it up, and given the way inflation is calculated, there are actually a lot more hacks to, front-running inflation than there are to front-running growth. And so what we've seen generally is, between housing data, commodity data, and transport data, you can basically model the impulse to take your measure, PCE, CPI, whatever you like over here. I think we've visualized CPI. And what we've generally seen is that this gauge is generally, a few months ahead of what typically happens with inflation pressures. Unfortunately, the inflation story, unlike the growth story, is just not that exciting. We basically see an environment where inflation is likely to basically stay around the current pace, which is a 2.25 pace. Now, that is modestly inconsistent with what the Fed wants. But at the same time, I don't think that's something that can move the Fed in any very material direction. And so we're likely to see, at least from a policy perspective, barring on what has been called a normalization policy, right, there is no major impulse from the inflation side, at least, to move policy. So that's what we're seeing on the inflation.
There was a lot of talk, right? I mean, for the better part of last year about what R-star was and,
Yes.
what the neutral rate, should be. And a lot of people were talking, that it needed to be adjusted upwards, given the economic growth that we're seeing.
Yes.
Right.
And I think the R-star conversation is a very fascinating theoretical discussion, but for most market practitioners, it's the concept of like the neutral rate is not that helpful, because the thing that most market practitioners are going to look to is you're going to look at the realized level of policy rates and then just directly go into what level of activity is that translating into. And so I don't need to figure out what R-star is, because I can already see the effects of what, the existing interest rate is. And yeah, maybe I can use those two to calibrate kind of like, okay, where I think R-star is. And maybe that influences the Fed somehow. But usually like monetary policy tightness from a practitioner's perspective is just measured by activity.
Right.
And so I think that it does make sense for, the Fed to be thinking about R-star and whatnot. But if we look at economic activity today, we have a pretty good environment. And the variety of reasons why that environment has existed despite the tightening of interest rates. But I think the biggest factor that we've done a good amount of work on understanding is how interest rates enter the economy, right? So how do interest rates enter the economy? There are basically two big levels, okay? There is how much ongoing borrowing is done, which actually fuels top-line GDP growth in the form of new investment. That ends up coming in largely in the form of residential investment, and also industrial equipment investment, and some amount of intellectual property investment. But the intellectual property investment in today's environment is not levered in the sense that we don't use debt to finance that; we use equity to finance that. So what we have is interest rates when they rise, they curtail future borrowing, so new activity slows, so the pace of activity slows. The other place where around, between the 1985 and maybe 2005, there was a huge effect, was the effect on interest payments for the private sector. That is a function of basically two things. It is a function of what is the interest expense that the private sector is charging within the private sector? So what is the net effect of what companies are receiving in interest from other companies, and how much are they paying to financial institutions and other companies? So you get that's one component of it. The second component of it is how much money is the government actually paying out in terms of interest income. And so
that's what I'm keen on.
Yeah.
And where are we in that dynamic? And you go in the 70s and you have 30% debt to GDP.
Mm-hmm.
So you have an impact on the economy and you have an impact on the debt payment.
Right.
Now you've got GDP or debt at 100% of GDP.
Mm-hmm.
So you have an impact from paying all the interest out on the debt,
Yeah.
as well as a slowing impact. So there's this tug of war between these two. And what I'm unaware of, or what I loved your opinion on, Aahan, is where are we at a point where one is actually making the other difficult to actually manage through interest rate policy? And are we there yet, or is that not calculable, or in your opinion?
So it's actually, the way we do it, it's actually precisely calculable. So the high level number is basically the amount of interest the private sector has to pay, or corporates have to pay. There are two components: private sector component and the treasury component. So treasury is income, right? So if the treasury gives you interest, that reduces your effective debt burden, right? Today, if you just strip out the treasury part of it, you basically have an interest burden of about 5% of GDP. Which actually, if you think about it, if we just lived in that world, and that's the world we lived in from 85 to 2005, that's the world we lived in. That level is restrictive. That level is restrictive because it's above nominal GDP. Nominal GDP is 4 today, right? But when you add back the income generated by treasury, that number sinks to about 2.5% of GDP. And so because we have such a big treasury balance sheet, a lot of which sits on the private sector in the form of assets, you have this effect where the net interest burden is lower than current nominal activity, which means that policy ends up being a lot less effective, right? And I think that what the main thing to just think about from a modeling perspective is like, okay, you have, typically the way people have modeled this is they've just taken the interest rates and said, okay, like, let's fit that to what are the interest burdens of companies. But I think what is missing is like the size of the treasury on private sector balance sheets. So how many treasuries does the private sector own? That number from 2008 to present has gone up by trillions and trillions of dollars, but given the multiple rounds of stimulus. And so what you have to do is you have to basically adjust your factors to basically represent this kind of change in asset composition. And so that, this whole discussion that we're having is, to the question Pierre originally asked, like, this is kind of the way I would think about, are rates restrictive or not? I would take the rates. I would say, what's the impact on the private sector? What's the impact on the income coming from the treasury relative to existing nominal activity? And that gives me whether it's restrictive or not. And, we're about 150 basis points not restrictive.
Interesting. Very interesting.
Well said, sir. That's well answered. Thank you.
So yeah, I think that basically looking at that inflation picture, I don't see a big. So there are a variety of, maybe they come up with or they continue to have a definition where, R star is lower. I don't really have any way of estimating what the Fed's estimate of R star is going to be.
Right.
But what I know that from like the actual realized inflation data, you're probably not going to have any major need to tighten further from here. And I think that is basically a neutral effect for treasury markets and markets in general. I think the next thing that I think is kind of meaningful is what is the outlook for liquidity conditions, which is on the next slide. Liquidity is an interesting concept. Just to put like a simple, easy to wrap your head around definition on it, liquidity is basically what is the capacity of the private sector to lever up and buy stuff, right? So for in at any given time, you can buy assets. What is your ability to lever up and buy assets relatively quickly? That capacity is determined by two big forces that generate liquidity. The first is how much liquidity is the government creating in the financial system, and then how much is the private sector creating by itself. I think one thing that is super important is that as QT or the roll off of the Fed's balance sheet kind of progresses, that level is becoming less and less important. And what is becoming more important is what the private sector does. And there are two big areas that define what the private sector does in terms of liquidity creation: how much repo is created and how much commercial paper is issued. The commercial paper component of liquidity is much less important post GFC because of a lot of regulatory change in the banking system, but repo markets remain extremely important. What we've seen over the last few months is a relative slowdown in repo activity. Part of it is a seasonality thing, right? As you tend to have a seasonal reduction in repo activity as you approach year end and quarter end. But another component of it is also that repo collateral, which is usually just treasuries and MBS securities, have experienced a huge amount of volatility as we described. And so, the haircuts on repo tends to be larger. As a result, your repo activity tends to reduce because it's marginally more expensive to do repo. And so what we're seeing today is a modest inflection in our tracking of liquidity conditions today. This isn't a liquidity panic event or anything like that. But what we're seeing is basically that particular segment of the economy has begun to slow a little bit. And that is a modest headwind for risk assets relative to safe assets.
Beautiful. This is, this has been a big question as well, right? It keeps coming up. Is, what are the liquidity concerns? And, people are always on the lookout for, is there going to be some liquidity shock down the road? But what you're saying, of course, is that there's simply a modest slowing happening as a result of the current conditions. But you don't see anything, you don't see any indications of liquidity concerns. Not yet, anyway.
No, at least at the current junction.
Yeah.
So I think the main thing to think about today is that people are used to focusing on the Fed now increasingly the Treasury for what is going to drive liquidity conditions, right? But I think that what is missed in a lot of popular narrative is like those two players are the biggest drivers of liquidity condition during crisis times, right? When they're doing a lot of stimulus, when they're reducing interest rates, when they're issuing a lot of short-term paper. All of those things are liquidity creating aspects, right?
Right.
And I think the big thing to consider is outside crisis situations, who creates all the liquidity? It's basically banks and financial institutions, right? And so when we look at those, where does the liquidity creating mechanism come from? That those entities are inherently pro-cyclical. Like they depend on cash flows coming from the economy, they extend credit into the economy. And so I think the one thing to really consider is the risks to liquidity now are much less so about like, is the government going to like stop providing liquidity? The government maintains stability during peacetime, eras. When it comes to liquidity, I think the thing that you have to be much more concerned about and keep your eye on is, okay, like what is the financial health of banks? What is the financial health of repo? Are companies issuing commercial paper? Are these short-term liquidity spigots, are they running fine? And I think the really, really like crucial thing to recognize is that Policymakers are countercyclical. Private sector is pro-cyclical. Today, we are going to be dominated much more by pro-cyclical conditions. And so if you actually enter, a downward spiral in the economy, liquidity is going to tank before it rises, not the other way around.
Right.
I think that's the thing to really kind of focus on. So to answer your question, is there going to be trouble in the liquidity ecosystem? It'll boil down to whether financial institutions are stable in extended credit or not. So far, things look good there.
Yeah.
Good.
So across growth, inflation, and liquidity, things look okay.
Things look
They
okay.
may not look as good as markets might be sort of expecting, or as we're seeing expressed through equity markets. Is that maybe what I'm picking up, or maybe we're going into that in the next step because we've established, hey, it's not terrible, but at the same time, are markets too excited about this? Where are markets price this in vis-a-vis where your indicators are starting to sort of suggest that it's all fine, but it's kind of meh.
Yeah.
And
And
I think we can.
I kind of,
Yeah, go ahead.
Sorry, Aahan, I just wanted to add, I kind of heard yesterday, correct me if I'm wrong, but quantitative tightening is coming to an end as well, right?
Yes. So the roll-off of the balance sheet is going to stop at some point later this year. And so that effect is basically completely, it almost takes the Fed out of the equation. And it reinforces this dynamic that I'm describing,
Right.
where the private sector is going to matter a lot more. To answer Mike's question, to answer your question, I think we can use two of these slides, Mike. So here we're just visualizing our GDP now cost, which, we add up about 75 different indicators, which add up to give us our GDP now cost. We usually, we can do this at various frequencies, but, just for ease of tracking, we do it monthly. But what we've projected is what our proprietary estimates are for forward GDP growth in the red line. And then the blue line just takes the most recent trend in GDP growth and extrapolates that forward. And so I think the two things to highlight. The first is the blue line looks very doom and gloom. And that's mostly because recent GDP data has not been very good by our estimates. There has been a significant amount of slowing in the investment components of GDP. And there are very particular reasons that I think we can get into. Our expectation for GDP growth is GDP growth of about 1.4%, which reflects the fact that the pressures that exist on investments are likely to persist, though arguably not at the pace at which they are currently reflected in most recent data. So we think that GDP growth is going to be about 1.4% over the next 12 months. Consensus GDP growth expectations are about 2.5 to 2.5%. And so is our estimate by no stretch of imagination is a crazy end of world recessionary circumstance. But I think that what you have to be really cognizant of, especially when it comes to equity markets, is that what matters for equities is earnings versus what's priced in. And GDP sets the potential for those earnings. So what we're showing over here is we have our timely measure, which updates weekly, of what the pressures are on earnings. Now, this gauge has a very, very modest lead on earnings expectations. And what we've shown over here is how, those earnings expectations tend to largely coincide with what our fundamental gauges do. So they're a very good measure of fair value. And two, if you squint and look at the far right-hand side, you'll see that the earnings expectations today are actually positive, while our assessment of those pressures is negative. And that's the setup for equity markets today. It's not that the economy is bad. It's not that we're going into recession. It's that the drivers of both GDP and corporate profitability are suggesting a weakening of corporate profits, while expectations are for positive corporate profits.
Yeah. So it's the gap in the expectations.
Yes.
Yeah. That's usually the case, right? It's the misread.
Always.
Yeah.
It's always
Everything's
the case.
relative.
There's It's always the case. You have to have a base portfolio from which you're betting against.
Yes.
And a lot of, I think, individual investors particularly miss the fact that there's a beta portfolio of some sort that they should just always be invested in, and their tilts should be measured against that.
Yes.
And this is great. So, and is it going to be the end of the world if these come in at this difference? Probably not the end of the world from the standpoint of returns, but this would certainly point to the expectations around equity returns being a little bit more positive than they might otherwise manifest if we're looking at the Prometheus earnings estimates, which are taking a few insightful angles and looking through things a little bit more robustly versus just the consensus. And that's always where it's most difficult, right? There's a consensus and you've got to bet against that consensus. But the nice thing here is you've got a pretty fantastic systematic process, which you go through on a regular basis and have some confidence in having that gap to make allocations on in portfolios, which are in effect bets against the current consensus.
Well, yeah, it's nice to see it visually represented. And
I think that's a really important part of like the whole process. When you come at it from a discretionary angle and you don't have necessarily the data to back you up, you're not always sure about the relationship you're betting on, right? Like, and I know I'm kind of preaching to the choir here, Mike, about systematization and whatnot, but I really think that it's something that we really strive to do is if you're going to bet on something, you need to have some proof that it works. And so like what we really strive to do is make sure that if we're going to recommend something or we're going to, have it in our portfolios, it has to be something that we've tested over time. And so that's really what the essence of this visual is. Now, I think that when you look at, in the broad scheme of things, like, is this a very major mispricing that creates a very significant investment opportunity? No. I think it's just a thing that you have to be cognizant of, because what we're starting to see, we have a very broad-based tracking of economic conditions. And looking through all of the different dimensions of economic data, we're starting to see more and more slowing signs. We're starting to see slowing signs in the labor market. We're starting to see slowing signs in investment conditions. We're starting to see all of these slowing signs. And the way we think about it is like you have to have a risk dial, right? Like I think I learned this from a mutual friend and a mentor of mine, Alex Shahidi. I remember him.
Of course.
I started my career working for Alex as an intern. And I remember him explaining this to me, and it kind of, it was like a light bulb moment for me. And he told me that all the best risk managers in the world think about risk exposure not in like an on and off switch, but think about them as a risk dial.
Right.
Yeah. A dimmer switch.
A dimmer switch, exactly. And so the way we approach this is as the divergences get bigger, our exposures will reduce. And so today, is that divergence really massive? No, but it's enough to be cautious. And that's really what our positions reflect today. We have we still have exposure to equities, but it's much less than we had, in the early and mid 2024.
And how much of this can be hidden by the sort of perversion that's going on in the major indices with respect to market cap weighting? Like that's another thing that becomes an interesting dynamic because such a few number of companies have an outweighted contribution to earnings. And now we're sitting there talking about a market, I'm using air quotes, of 7 to 12 stocks, which is that actually reflective? So you could see something happen under the surface that's a little different, right? So broadly, the lesser caps, the white caps, we'll call them, don't participate, but the mega caps do, or vice versa, where these things manifest in a way you do get a broadening of the market, and all of a sudden the market's broadening out in equal weight, and smaller mid caps start to participate. But yeah, I guess we could probably think through that a little bit and think through the funding obligations of those companies downstream. They operate a little bit differently in the way they don't usually have a ton of treasury, right? They're borrowing more on the front end of the curve rather than on the back end of the curve, where these mega caps are sitting with large treasury. They've got large monies coming in, payments on the debts that are funding them, plus they have massive growth. So how does that, kind of trickle through the economy? Lots of gray zone to make sure that you're not too confident in, even, what we're seeing, the difference between earnings expectations and Prometheus earnings expectations. There's lots of going on under the surface where you can't be absolute about it. As you say, a reduction in risk exposure on the dimmer a little bit. And maybe it might be a highlight to go through some of the older periods. Like I look at that 2000 to 2002 period where earnings expectations were much higher, but you see the Prometheus expectations continuing to fall through the floor. And having lived that period and people saying, buy now, buy the dip, and just watching markets continue to roll down as earnings expectations were disappointed. Whilst, the gauge in Prometheus, maybe you can highlight some periods like that where you saw the dispersions to help people build some intuition.
Yeah. I mean, I think, regarding the large caps, I think I have a very, perhaps, let's call it a divergent view from a lot of people about the large cap, the bias that we have in terms of having, a concentrated index where 10 stocks are dominating the price of action. I think it's a really good alpha opportunity. The reason I think so is because let's be very clear. Trading, mispricing the earnings expectations, all of these types of things are very high alpha endeavors. It's very difficult to do. Right? You're basically, you need to be very timely. You need to be able to adjust your positions every day. You need to really, really have a very firm grasp on what's happening in markets at all times. But those alpha opportunities tend to be relatively small to the big hitters. What are the big hitters? The big hitters are the recession. That's the biggest alpha opportunity you're ever going to get in equity markets. If you want to improve your return stream for equities, figure out how to predict recessions. Now, I think the really great thing about that is that if you're looking at macro data, the macro data is less biased to this concentration effect, right? And what ends up happening is a recession, somewhat by definition, and also just, by the way macro dynamics end up working, is they end up being a self-reinforcing spiral. They end up being a self-reinforcing spiral because the transmission mechanism for recessions is layoffs in the job market. And, workers have a dual purpose in the economy. They receive income and create stuff, but they also spend. And so when you start to have layoffs, right, in aggregate, you reduce both the laborer's income, the laborer's income, and at the same time, you also reduce the income for other people. And so what ends up happening is a situation where people start to get laid off, and that creates this non-linear kind of downshift in the economy, which gets reflected in the markets. Now, if you have a lopsided index that only focuses on a certain set of companies that receive cash flows no matter what, you actually have an opportunity to get in front of that non-linear event. And so I actually think that, from that kind of perspective, a lot of why you have these earnings expectations lag a little bit is because they have a blend of both large cap and at the same time momentum, right? And you actually end up having a situation where these macro dynamics can diverge. So I actually think that as someone that's trying to generate macro alpha on these type of events, I actually like the index composition. Because it hides a lot. It hides a lot. So markets are mispriced relative to what I see.
Yeah.
Love that.
So that's the edge, right?
That, and I probably ruined it right now, didn't I?
That's funny.
I'm sure everyone's just going to reprice everything based on our conversation today.
Yeah, exactly.
But then your models will pick that up and say, hey, we're repriced. We can get back in.
Yeah, exactly. Hopefully. But that's the type of thing, there are all these little small nuances, and as you know, like you just keep trying to stay ahead of them and keep trying to understand whether they're going to keep working or not, right? And so, um, I just think that, yeah, in a lot of ways, have the I think that for the no harm portfolios that we've talked about in the past, like balanced risk parity portfolios and things like that, the the weighting effects of these big tech companies and such, they have more of a meaningful kind of distortion over that. But when it comes to these alpha opportunities, I always find it interesting that most macro pundits will hate on the Fed, for example. Um, if they did their job right, we would not have jobs. So, these small mispricings and these small policy errors and this, like the the perceived errors in index construction are all things that help us add value. So that's kind of just the way I look at it.
Yes, if the market was perfectly efficient, we wouldn't need any of us.
None of this.
We're all working to make it efficient and take advantage of the vig between the current status and total efficiency. So, I mean, that is part of what we do in markets for sure.
Yes, sir.
Okay, so we've got a backdrop that is slightly maybe too positive for growth. And so how's that factoring through to assets like commodities? I see, not a lot of weighting there. And then we've got an overarching sort of election, incoming presidential elected drill baby drill type thing where we're going to add 2 to 3 million barrels a day of hydrocarbons to markets. How do you see that playing out? What do you see as the threats and opportunities to your forecast? So obviously we've got a great plan.
Yeah,
we're going into the ring with Mike Tyson. We're going to get punched in the face.
There's a lot of policy risk, right?
We can circle back to what happened December 18th, and then also speculate to some degree on what would an oil shock do? What would a collapse in hydrocarbon pricing do? And how would those impact the various legs of the stool?
So I think the main thing so we've done a lot of work on trying to understand what drives commodity prices over time, right? And of course, I think the prevailing understanding is that it's a global thing, and it's really tough to do. And the most popular approach that I know that you guys are experts in, Mike, is typically trend following or some type of macro trend kind of program. The thing that we've spent a lot of time understanding is basically the way we see commodities. Commodities are the top of the inflation funnel, right? And at its core, what is inflation? Inflation is basically the relative balance between nominal spending and the existing amount of output. And so what we try to do is we try to understand what is driving that nominal spending relative to the existing amount of output. And the difference between those two things is basically the looseness or tightness of the system, right? So when nominal spending is really, really fast relative to output, you have really tight conditions, right? Which results in inflation. So one of the key determinants of whether production conditions are tight or loose is basically how much profits exist in the manufacturing sector, because manufacturing profits are what determine whether manufacturing companies are going to lever up and keep people employed. And so what we found over time, not all the time, I think this is something I emphasize all the time, over time, what we've seen is the primary determinant of big moves in commodity prices is changes in top line leverage driven by changes in bottom line in the form of profits. Now, when we go to the manufacturing sector, we do quite a bit of work to basically create nowcasts for what are their estimated revenues, what are their estimated wages, what are their estimated interest burdens. But for the sake of simplicity and a nice visual, what we've done is we've just taken the wage costs over here. So what we visualize here today is what are the sales of the manufacturing sector in the United States. That's the line in blue. And then we've estimated what is the wage cost. And that's the line in red. And the problem we have today is that the wage rates that are being paid by the manufacturing sector far exceed the ongoing pace of top line growth. And so without, you know, and so how do you deal with this problem as a manufacturing sector? The only way to deal with this problem is somehow you can either reduce your wage rates, you can reduce the number of hours people work, or you can reduce the number of workers. What we found is they've already begun to reduce the number of hours people work. And they have also begun to somewhat reduce the number of people that are in the sector. So the only way to really create a little bit of cushion for profitability today is actually to have a bigger segment of layoffs. But that layoff process tends to be, as we've described, a nonlinear kind of happening, which ends up creating a self-reinforcing spiral downwards. So if one company fires people, that's fine. But what ends up happening is when one company fires people, another set of companies end up losing some set of income. And as a result, you have this kind of, this growing effect through the sector. And so the place we've been at today is not including any interest costs, not including any operating costs or anything like that. We're in a situation where just the wages are too much for the manufacturing sector to have a positive profitability position. And so that leads us to be so we started getting bearish. I remember we communicated to our institutional clients and then by retail publications starting around November of 23, is when we started to really say, hey, like this is kind of an issue. And, our process was so different from what everyone else does. We kept getting questions back. Hey, look at these PMIs. Hey, look at this, look at this global industrial production rating. Hey, look at this. And the most consistent theme that we've had since the end of 23 till present is that the pressures that exist on this manufacturing sector are too large and not enough has been done to basically reverse those pressures. And so until you actually get this firing cycle in manufacturing, you're just not going to be able to exit this bad spell.
It's really neat to see it visualized. I think, this is the reason why so much manufacturing was offshored in the first place.
Yes.
This long-standing problem of made in America or, made in North America is that the cost of manufacturing here is wages versus revenues is too high to make it something worthwhile. And I know this part of the rhetoric, the political rhetoric of the incoming administration is to levy tariffs on everyone. But that's inflationary. That's the argument, right? If we want to have a strong domestic manufacturing sector, we not only have to pay people to do the job, but then we have to charge more for the goods in order to recoup that and to recoup the profits. But nobody wants to be in business to break even.
Yeah, absolutely.
Or
I think
lose money. And one company offshore, when one or two big companies started offshoring to China and India, all the others saw the same opportunity and said, hey, we need to do the same thing. Otherwise we won't be able to compete with them.
Yeah.
And that was the landslide of manufacturing in North America. But, you got to wonder if this policy of imposing tariffs on all of our trading partners, on all the U.S. trading partners is the way to go. It's definitely problematic.
I think this is just going to be something that's really hard to break out of for this sector. There is one level they can use, right? Which is to increase their existing amount of borrowing, right? Like I think that's the main thing, because when you, as a manufacturer, when you increase your amount of borrowing, depending on the lead time, it actually results in production and output and things like that. So you could push your sales that way in the macro aggregates. But the good part about that is that we have relatively timely readings of that as well.
I mean, before we leave that, even we'll come back. Yeah, keep going. I'll kind of come back to it.
All right.
So so we have this existing sales problem relative to the existing amount of wages. Just to perhaps underscore, by our estimates, the manufacturing sector about about 40 to 60, somewhere in that range, 40 to 60% of revenue goes to wage cost. So it's a big chunk.
Right.
And that's not factoring in any interest burden, which is the manufacturing sector actually has the largest interest burden of the entire economy. And the only way for them to really deal with that problem, other than firing people, is to be able to take on more leverage, increase output, increase sales, right? But what we're seeing in timely data, so the visual we're showing over here, is we've basically taken nominal gross investment, which is the blue line. So that's how much investment there is in GDP, right, on a nominal basis. And then we've taken how much of that investment can be explained by leverage, both from real estate and from manufacturing, right? And we basically, done a rough estimate of how much is actually flowing through. And today, when we look at those numbers are negative. So we've had the easing of policy. People are like, oh, you've had an easing of policy. There should be more borrowing and this, that, and whatnot. But over the last year, you've actually had a contraction in borrowing from these sectors. And so I think the difficulty is that the profit dynamic is bad. The outlook is not necessarily of an extremely robust, strong economy that's going to power the next manufacturing boom. That time actually happened, as a result of chips, like the CHIPS Act that spurred a whole bunch of investment and whatnot. But that seems to be behind us and that is fading. And so as a result, there isn't actually that much leverage being taken in the sector. So without that, it's going to be really, really hard. If we do add this reshoring dynamic, the wages are only going to go higher. And so unless the wages go higher and the leverage increases, we're going to stay in this negative profit dynamic, which is going to be a damper on the demand for commodities, which is why across strategies, we've been generally not in favor of commodities for at least 9 months now.
And rightfully so, by the way. And it's, if we pop back to the previous slide and sort of look through how not precise is the wrong word, but how this indicator seems to work. You see that blue line crossing above the red line back in 2002 approximately, which was the birth of a massive commodity bull market. And you see that blue line maintain in fairly significant distance from the red line until 2008, which was a wonderful commodity super cycle. You had the 2008 recession, that you had things kind of come back to fruition to 2012, and then really kind of 10-15 years of not really much going on, which is exactly what happened. Commodities were oversupplied for a decade, and really just didn't deliver much of anything in the way of diversification other than a drag on performance and added volatility. So from the perspective of something that's prescient to help you in a longer term, from a longer term perspective, think about commodity exposure. Certainly doesn't look like it's a compelling aspect of things to be including the portfolio at the moment. It looks like a hard pass, which is why you guys have got such low exposure. Now, how do you flip this on its head, and is there shorting opportunities then in this area where in your alpha portfolio you're looking at being short some of the commodities?
Yeah, usually I avoid discussing the two portfolios, but I'm sure you guys have a more sophisticated audience. So we have a pure alpha portfolio which turns over every day, changes its mind about things all the time, based off every tick of all the data that we're showing.
Incredibly important point too, Aahan. So I will help you emphasize this, that if you say something in this moment, by tomorrow it could be different.
It could be completely
different. So, but in the moment, in the context of what we're talking about, it might help inform people and build some intuition again. But good caveat that in these markets, when you're trading that type of thing in an alpha-based portfolio, you're looking at sizing daily, you're looking at long, short daily, and you're looking at those implications between that asset and other assets in the portfolio for sizing of risk and whatnot. So very complex situation that occurs in all of that. So we should emphasize that to the listeners. With that caveat, back over to you.
That would also be the difference between a long only exposure to commodities versus trend following exposure to commodities.
Trend following will be short as well. Trend following will be short.
Yeah, that's why. I mean,
so
trend,
be short.
If you're in a trend following strategy, you'll get, exactly.
Yeah. So our ETF portfolios and our retail portfolios, by and large, are long only portfolios. But we do operate, as you alluded to, we do operate alpha strategies, which are for professional investors, given the complexity involved in implementing them on a daily basis using futures. And so those portfolios have been pretty consistently bearish on commodities, and actually, on a fundamental basis, do remain bearish on commodities as well, even now. And so I think that is, it's funny, you front ran exactly what I was thinking of, when you were talking about the mid 2000s and the mid 2010s and the difficulties for commodities in terms of diversification. The first thing that popped into my head was, but not on the short side. Right, because they were wonderful diversifier and additional portfolios on the short side. And I think a very nice way to actually think about a lot of dynamics that are playing out today is that it's a very similar version to what happened during the 2010s now. I mean, but barring the effects that we're having on bonds, largely because of what's being priced in, but on the commodity and equity side, we actually have a very similar dynamic where growth is probably going to be slow, relatively stable, not very exciting. And by and large, equities actually perform really well during those environments. As long as growth is ticking along, equities tend to do pretty well as long as inflation is pretty muted. And we don't have a big earnings contraction. They can, be mispriced and whatnot. But during those types of environments, unless the economy is accelerating, right? So if you go back to the analogy that I made of tightness and looseness in production, right? Unless the economy is accelerating, commodities tend to do really badly. And so what we're looking at is a situation today where you're actually going to have slowing of the economy broadly. You have this manufacturing profit problem that's actually going to reduce in a weakness in demand for the inputs and outputs of commodities themselves. And so as a result, when we look at today, the commodity picture is just not one that we think makes sense. And so we don't have them in our long only portfolios, and we have generally been short them in our alpha strategies.
Yeah. It is a disinflationary growth environment, right? You've got growth at a moderate pace where the inputs that drive that growth are not really in short supply. The growth isn't so burdensome that it's creating that inflation out the other side. And so it's kind of not a bad place to be, generally speaking. It's not great for commodities on the long side. It's kind of like the 10s, like it's kind of that. Unlike 2002 to that 2008 period where you had growth, but that growth was inflationary growth, and you had pricing driven through the bottom line of oil and gas and inputs to the economy, which aren't necessarily that great for U.S. dynamics, right? Where the U.S. is using a lot of those inputs back in the day when they didn't have, the oil production and gas production they have today. So those dynamics might change a little bit too. But those were different dynamics. That's an inflationary growth dynamic from sort of 2000 to 2008, where you get this feedback loop of the commodity cycle actually causing more cost increases, causing more demand for commodities, causing the price to go up further. And that hurts the profits of those, generally non-producing commodity using areas, like the US was a little bit more like that back then. It's a slightly different context today. So
well,
the example is there. It also it's changed a bit.
What if Cam Harvey's inverted yield curve indicator was just simply a lagging effect of the pandemic blowout? Like if you look at
this is a great point. Just to get, let's talk about that. Just generally,
if you look at looking at the analog of post 2008 and post 2022, the like what if the recession everybody was expecting already happened?
hmm So I think the way I would frame this is the effect of manufacturing. Mike, I think we've actually talked about this on a previous part, but the effect of manufacturing has basically changed over the decades. So, basically with China entering the WTO and whatnot, you basically had a slow reduction of manufacturing as a percentage of the rest of the economy. So if you wind back to the glory days of macro, right, like 60 to, maybe 95, something, like those days, manufacturing was the center of the economy. And so every manufacturing cycle basically translated into recession or expansion, right? But as the manufacturing economy became smaller and smaller, it needed to have, the moves needed to be more extreme. So I think when you look at something like, there are two very, very popular measures of are we in recession or not, business cycle measures. One is the yield curve that you referenced, and then there's the conference board leading index, which includes the yield curve and a range of other measures. Now, I'll talk about the yield curve in a second, but the conference board leading index, for example, has a huge weight. Basically, I think about 7 out of 10 measures are all manufacturing oriented measures. But the problem is that today, okay, we have this negative profit environment. It is resulting in firing in the manufacturing sector and all of this stuff. But the hit to GDP, to total corporate profits, and to employment is still muted. So these things are negative. But the thing is, if you imagine that you have 2% payroll growth year over year, the decline in manufacturing is contributing maybe negative 20 or negative 30 basis points. And so the weighted effect of manufacturing on the economy is now much less. Now, to your point about the recession having happened, we've basically been in a manufacturing contraction for more than a year now, right? And so if we were in the old world economy of the 80s, right, that would absolutely be a recession because it would have such a weighted effect.
Yeah.
But today we don't have the same composition of the economy. And so when we're looking at the economic circumstance today, it's one of the things that's going to result. So that slowing of the economy that we've been talking about, right? From the current pace, the 1.4% growth in 2025. What makes the economy slow? It's basically that manufacturing and a couple of other sectors, we can talk about those sectors if you like, are going to basically put a damper on everything else that's happening. That's the dynamic. So this manufacturing dynamic where we have this weakness in profits, it exists in other sectors too. And those sectors are the sectors that lead to accelerations in activity. So if you look at there are two components of economic growth over time. There is the stable trend of, GDP growth, right? And that's one component. The second component is the cyclical up and down. So the accelerations and the decelerations. There are certain segments of leverage intensive businesses that drive the accelerations and decelerations. And those leverage intensive businesses are starting to have a little bit of a tough time, both because of, existing interest burden and the existing wage costs today. And so as a result, this manufacturing dynamic earlier may have resulted in recession. Today it's just going to result in slowing.
And so that's reflected in the Prometheus models that your output, the 1.4 GDP versus expectations of 2.5 or 2.5.
Yeah, and Mike, this in the name of humility, this hopefully what I think is an insight. It came from me getting stuff wrong, right? So the way we do
it, brother.
Yeah.
yeah. The way we used to do it is we used to do something similar-ish, but we thought that we could do better than what the CLIs were doing, and we would estimate kind of like a multiplier or a beta of these industries to activity. So like if you're a nerd, we used to fit what was happening with the manufacturing to the rest of the economy, try to estimate, okay, like this is how much pass through, blah blah blah. And the fitting process doesn't move fast enough. It doesn't move fast enough because of the slowness of the data, right? Like the slowness of the data, you get GDP data quarterly, even if you have a nowcast, you make it monthly, like the fits will change too slowly. So what we started doing, this was like a serious thing that really like it added, like a lot of performance for our strategies, was we started saying, hey, how do we estimate the actual dollar impact of each of these things? Not the fitted impact of each of these things. And that led to like a full bunch of improvements and like a robustness of understanding and improvement of understanding. And so like I actually, we did at one point have, in early 23, we saw what's happening with manufacturing economy, what's happening in the real estate economy, and we saw what's happening to our GDP nowcast. And we said, like, okay, if we look at our fits and we basically estimate what typically has happened, this looks pretty bad. And, for a couple of months, I had egg all over my face, the spoos ripped to the moon. And, during that time, I was constantly like, how do I figure this out? And how do I explain this? And we spent a lot of time trying to build this understanding of like, what is the dollar impact of each of these industries to GDP, to profits and whatnot. And so when we look at that today, we can have a much more precise understanding of what is the actual hit to GDP. And today it's just not big enough.
All right. Great insight.
Yeah.
Fantastic insight of the fundamental changes of an economy over time, over decades, which manifest in very different outcomes. Fabulous learning right there. Yeah. And do you take advantage of all of that now in your Prometheus research?
Yeah.
Those learnings are there. Is there anything else that you want to cover and that we haven't touched on as we walk through the deck? Is there anything else that you want to really kind of draw some attention to and point a sharp stick at, if you will?
I think the one thing that I will add on the picture, maybe, one more thing on the macro front, and then one thing in terms of the way we're translating this into signal, because I think that is the most value like I can generate. Like, okay, we've talked a lot of macro stuff.
Yeah.
I think that I love giving people like tangible things that they can really like
make it actionable, provide understanding and intuition 100%. Let's get to that, because that's going to be where I think the value add is for the listener too.
So I think the one thing that I'll quickly touch on is that the dynamic that I've described in the manufacturing sector, we can model that same dynamic in the real estate sector. And that I think is super, super noteworthy, because one of the things that people really look at now and have looked at over time to understand whether we're going into a recession or not is whether construction payrolls and real estate related payrolls are going into contraction. And what we found is like, you can do better than that. You can do better than that by estimating what are the profit pressures in the similar way as we have done in manufacturing on the real estate sector. And so what we have visualized here is the revenue of real estate companies, both in residential and non-residential companies put together, and what are the wages that they're paying. And what you can see is that the recent slowing of construction activity has actually created a similar dynamic, where you actually have a situation where now the wages are just too high even in this sector. Now, I will say, I will caveat this by saying that like our modeling process for these real estate revenues is not as good so far as our modeling process for the manufacturing sector. And so we the official numbers, which are a little bit slower, have the contraction as a little bit less than we have them. So we think the numbers are a little bit worse than the official numbers that are stated. But that being said, that profit pressure still exists here and is starting to, become a thing. And if it continues for a while, you're basically going to have the same situation. Now, construction, unlike manufacturing, is a pretty chunky piece of economic activity. And so if that dynamic develops over here, we could see a pretty different, economic outcome in 2025. But right now, early days, we're starting on that process. So I'll just pause here if you guys have any questions on that front. Otherwise, we can just kind of get into signal if you like.
Well, no, I mean, it's a great point. I think you've seen since the end of November, if you look at the home builders as a proxy for however you want to look through this, I mean, they're down sort of 25%.
It's an excellent indicator, by the way.
Yeah. So you've got the home builders XHB, the home builders ETF. It's a pretty significant decline over the last 7 weeks. And, and precipitous, fast. it's telling you something.
Mortgage rates,
Yeah.
right? Look at what's happening with mortgage rates in the U.S. I mean, anybody looking
There's
for a
another
new
compounding
mortgage,
factor too. Yeah.
right, is they're nearing 7% for a 30-year, right?
Mm-hmm. Yeah.
That
And so like between the mortgage rate impact and you look at these are timely reads of what's happening in the sector, right? So what's happening to the equity price, what's happening to timely like permits data. That permits data has sorry, not permits data, the mortgage applications data, which comes out every week. You look at the mortgage rates that we discussed, you add these up, these are pretty timely reads, and those have started to deteriorate as well. Which just is like a fast filter of the dynamic that we're trying to visualize here. And so when we see those fast filters kind of augmenting what we're seeing in these fundamental dynamics, we gain more confidence that the fundamental dynamics that we're trying to estimate actually are coming to fruition. So definitely something I think I will be keeping a close watch on, because like when it comes to business cycle analysis and recession forecasting and stuff, the real estate is really like the big daddy, and that is even in today's economy.
Great insight.
Well, I mean, what is that? And that potentially also means a tightening of real estate supply and price,
Yeah.
price stability, right? At the
I think the problem with real estate supply is that we still have, so a lot of the resilience of construction employment is because there has been just a huge amount of backlogs in building.
right.
And so, you actually have a huge amount of, so the construction process goes through permits, starts, and then completions, right? So there has been just a huge divergence between starts and completions. And so, I think that you have a similar dynamic to this actually in transport, where you have just a massive backlog. But basically, transport and housing have these huge kind of like ongoing projects that have started but just haven't finished. And so it might actually contribute to a little bit of resilience in the sector relative to what you may have seen in the past.
Excellent.
It's amazing how, I mean, it's again with the visual representations of what we're talking about, and your quantification of that. It's really interesting to see it visualized, to actually see it in something a little more descriptive than just a simple discussion, of course.
Yeah,
If you look at the blue line versus the red line in
Yeah.
a number of these graphs, and hopefully people will be able to tune in video, and we can post the slides to this as well. But I kind of look at it as is offense on the field or is defense on the field, and it's kind of in a position where in these last couple of examples, defense is on the field. Like you're not throwing the 100-yard bomb at the moment to try and win the game in these particular areas of sectors of the market.
Yeah, definitely. We can actually quantify that in the last few slides.
Yeah, let's do it.
So, okay, we've done all the macro spiel, and we've talked about this, that, and whatnot. As I discussed at the onset, right? What we do is we basically look at what we think is going to happen in the economy, growth, inflation, liquidity, and then we look at what we think is attractive in markets and what's being priced in the markets right now. We add that up, and we come up with signal strength, which ranges from about 1 to -1. And what we can do is we can say, hey, like if we have a signal today, what are the expected returns we generate tomorrow based on that signal? And this is one of the things that I'm most proud of. We've simulated this back to 1965, and this is in a long only weekly portfolio, which as you know, Mike, is pretty hard to generate, like the very very significant alpha on those type of time horizons. But basically what we're showing over here in this slide is basically like our signal strength has generally had a very modest kind of linear relationship with the future returns. So if you're looking at let's if we just grab the the most standout, which is basically bonds. If we have a signal strength of 100, we tend to have very positive 10% plus returns. If you have a signal strength of negative 100, you tend to have really, really negative returns. And it is distributed like that in commodities as well. Equity is a little bit less so, and I think that is just, I'm nerding out a little bit here, but that's just a little bit more to do with the pause of history than it is has to do with signal quality. So, we've never tried to condition things based off how effective has our signal been, and generate a signal based on how effective our signal is. We should basically just hold, if we have a -1 signal, it's a full negative conviction. But I think that, this is just to help people understand that, hey, like everything that we've talked about, we've tried to quantify, we've, put it into, a systematic portfolio process, and we basically trade based off these things. So we can actually go through each asset real quick and kind of talk through where those signal levels are roughly at. So here we're just visualizing the equity signal over time. And we have put in a little bit of smoothing and whatnot, because it's just like it can be a lot. It's a lot even now. But I think the main thing that we're trying to highlight over here is that, if you look at what, cross assets. So if you look at equity market internals, then you look at equities relative to other macro assets. Recent price performance has generally been that, oh yeah, like equities are the best thing in the world, right? But the thing that is starting to make less and less sense to us is that, okay, like the earnings expectations are really positive, but the growth outlook is negative. And so between those two things, we've actually had a significant moderation of equity signal over the last quarter. I'm going to pat myself on the back, but I think that has coincided with a relatively more choppy time for equity markets than like the first 3 quarters of 24. And so I think that as we move forward in the year, if we start to have our fundamental our fundamental views play out the way we expect them to, then we probably have more and more negative equity signal over time. So right now we basically have, relative to history, we have about neutral-ish, modestly positive equity signal. Now, these signals translate very slowly into our portfolios, because we want to be able to give retail investors something that is relatively stable over time. So I could easily, sell someone a subscription and be like, yeah, we have signals that change every single day. Just keep trading all of them between transaction costs and taxes and whatnot. You would make no money doing that. And so what we try to do is we slow down signals, and we basically do an accumulation of signal change over time to basically say, okay, it's time to change positions. So we still, while we do have a modestly positive equity signal at this time, we're still maintaining an equity position. I think this is an interesting one. What you'll see is that signal strength, after being tremendously negative, and I think that, empirically we've had the most edge in bonds. We had a really, really good performance in 23, and 24 was pretty good for bonds as well. I think the really important thing to notice over here is that as yield curves slowly start creeping into positive territory, the return on risk of bonds starts to look more attractive, particularly given a prospective slowing in the economy. So first off, like a very simple observation, like the simplest thing we can give, carry is a good thing, right? Like positive carry versus yeah, positive carry versus cash is always a good thing, right? And then there's a question of like, how much risk are you taking to achieve that carry? And the variety of dimensions you can use, both macro and just like quantitative dimensions you can use to quantify that carry. So starting with that, like as you get positive carry, it starts to become more of a reasonable proposition to own bonds. Don't own negative carry assets is something I would generally say, unless you have a very specific need. But as we start to creep into positive carry kind of territory, you have a situation where we think the economy may also deteriorate, which could actually elicit maybe more cuts than what's priced, or it could just move the pricing. Either way, slowly, we're starting to get to a point where bonds are starting to be more attractive. We actually have had, steadily over the last few months, our bond allocation just begin to rise and rise. Over the last few weeks, that has not been, candidly, that has not been a pleasant process. But I think that, you want to, if somebody is only allocating pro-cyclically, you need to understand that, like, you basically have like a synthetic trend following approach, right? And that is amazing. I love trend following. I've always been in sport. Trend following is better than not trend following, without a doubt. But only trend following and convincing yourself that it's not trend following is probably not a good idea. And so, what we think is that, okay, like bonds are bear steepening right now, but their bear steepening actually incrementally just keeps making them more attractive.
Right.
Precisely.
And so,
And that carry that you're referring to is what you're seeing portfolio managers rotate into. As we
Yeah.
saw late December, we saw a lot of overinvested portfolio managers. If you looked at studies of how invested are the portfolio managers out there, quite invested, almost leveraged, which often leads to a rotation of some kind. And so trend is kind of an easy signal that people get. If the price is going up, it's going to continue to go up, and you're using that as the determinant for assuming what future price is going to be. And same on down. If it's going down, it's going to continue to go down. Carry uses it's a very different signal in that it's looking at what you get paid if nothing changes, right? So you're just getting this positive carry. People think about this in the dividend context. What's the dividend of a stock? Or big dividend payers, right? That's what we mean by positive carry. Well, as bonds, as you say, start to continue to add more positive carry, well, that's got to be in comparison to other assets like equities. And so you start to get that rotation through, and it's a different signal, right? And if you're able to harness that signal, you're getting in while it's opportune. You're not waiting for the moment to say, oh, finally the trend is reversed. Carry's now narrowing to the point where price is going up enough it's reflected in trend. You're kind of late. The nice thing about carry across multiple asset classes, including bonds, most predominantly in bonds, is that you're seeing that carry now. So this is an opportunity to think through how that is competitively reflective against your stock portfolios and on your multi-asset framework. Is it at some point, I mean, if carry on bonds is 10%, that's going to be very attractive versus equities. We're closing it on 5%. And I think people may not understand the nature of a pro-cyclical versus a counter-cyclical, because that spread is still widening and you're allocating to it. You're in effect wrong for now. You're very slightly wrong, but you're going into the market when the market is willing to give this to you. And you're getting fills at those nice juice. No one's arguing with you on your fills. Now, if it starts to rip the other way, all of a sudden you're chasing. And that's what Aahan means about pro-cyclical. Oh, the rates have started to close. Carry's starting to actually attenuate, which means price is going up, but now you're chasing that rather than having been already positioned in your portfolio for that eventuality, thinking through rebalancing, thinking through the competitive nature of allocating your capital across these different asset classes based on the signals you're getting from those asset classes.
You have to do it, right? I mean, in bond investors right now with that duration, if we're talking about TLT, they're lamenting holding it, right? But rebalancing out of your winning equity position into this losing, duration position in bonds is the key to the success as an investor. It's not, and it's contrarian, right? It's hard for investors to say, oh, I'm going to sell my winning, S&P 500 position to buy more of the TLT position or more of this duration position in bonds. It's got to be systematic. It can't be something that you sit there and ponder. Behaviorally, it's a pitfall, right? I mean, investors are not, if you call up a retail investor now and say, guess what, we're going to sell some of your winning SPY position and put it into TLT. It's like, why the hell would we do that? What if
this is why trend and carry are so complementary?
Yeah.
As signals to actually generate an investment portfolio from, they're giving you two different tales of what's happening in a market. And thus they provide very non-correlated returns to one another.
Yeah. I think an interesting nuance I can provide regarding the carry also is, when you're evaluating carry, I think the convention in most quant circles is to use a carryover vol or use a carryover, some type of, price risk measure, right? And I think interesting alternative that we've definitely employed in some way, shape, or fashion is to look at carry relative to the probability and extent of prospective monetary policy easing or tightening. And so I think so, you can imagine a world where, let's wind back to, Let's imagine a world where you have a positive carry kind of environment, but you also have an inflationary environment, which is, far in excess of Fed target, which will elicit a tightening of monetary policy. If that tightening of monetary policy exceeds your existing carry amount, you should probably have a zero signal, right?
Right.
And what I'm saying today is that the amount of carry you have is just about justified by the amount of easing you're going to have. So like you should have a modest amount. Like it basically tells you that, oh yeah, like beta is fine. Like I could own some beta over time. But can I generate a lot of excess return at this point in time from just owning bonds on that basis? Probably not, but it's something to slowly start considering as you get more carry and you get less interest rate volatility.
Great points. Great inputs. And so your bond signals have been pretty strong. So you're sitting in that 0 to 50 range.
Yeah.
Which means, again, even though, as Pierre points out, even though the recency bias of someone looking at the price action of TLT as an example may cause them to pause, this is the opportunity where you can allocate to your portfolio when the market's coming at you, rather than chasing the market in a pro-cyclical approach. And you have some signals, as Aahan pointed out to, that they've tested, that they go back to 1965 and say, probabilistically, this is weighted in your favor. This is how you want to establish positions in your portfolio. And at a minimum, you should be certainly at your base portfolio allocation of bonds at this moment in time. Maybe
the signaling is exciting, actually.
If you were a 60-40 investor, most people, because of drift in their equity portfolio, are now 80-20.
Yeah.
You should be considering that rebalancing back to a 60-40 in some way, shape, or form to get that more neutral portfolio, considering what we've talked about today.
Yeah, I love the signaling. I think the signaling as a tool, for investors and for advisors especially, I think that's incredibly valuable, is to be able to see this signal being generated on a daily, weekly, or monthly basis, is actually compelling. It's a very compelling tool to actually see it quantified and displayed, where if you ignore it, you do so at your own peril.
The sad state of affairs is ignoring it over the last couple of years has absolutely been, if you've been equity heavy, this is the challenge with diversification and these types of things, is that you're always having to say you're sorry.
Nonstop.
Yeah, absolutely. And,
Nonstop.
I think, just to head to, I think, commodities, if we could.
Yeah, sure.
I think that's the last one. So, the commodity signal, I think we've talked about the fundamental part. Like the question of what's priced into commodity markets is a question of like what is priced into the term structure of commodity markets. And when you look at those term structures largely tend to reflect inflation trends over time. And what we're seeing today is we're seeing actually, like, from an alpha perspective, it's really interesting, but like from a beta perspective, which is in the ETF portfolio, is like you should avoid commodities, because one, you actually have commodity markets with negative roll yields at this time, and at the same time you also have a really, really bad kind of fundamental dynamic. So commodity markets are basically priced like commodity futures in the future, or as you go forward in contracts, are going to have higher inflationary pressures, but the existing inflationary pressures via the manufacturing sector that we described in the past are actually negative. And so you have this interesting confluence where commodity futures markets are priced for higher inflation, but the likely outcome is actually going to be lower inflation pressures for commodities. And as a result, we think that commodity markets have and will probably remain like a negative signal. And, we've maintained that for quite a while. As you can see, the signal is relatively, we're at that negative 50 kind of mark, which generally portends to pretty weak returns for commodity markets. We've had pretty bad commodity performance over the last year. At this particular point in time, if you were to ask me across the portfolio dimensions, like where I actually have a modest, the most conviction, it would probably be that commodities are probably not going to be the best bet.
And how does gold factor into your commodity? Do you look at gold as a unique asset class? Do you factor that in some of your allocation methodologies and so on?
A few months ago, maybe, let's say like maybe 3 or 4 months ago last year, we actually dropped gold. The reason is not because I don't like gold. I think gold is a fantastic asset. I think that gold should be part of anybody's do no harm portfolio, right? As a separate asset class in itself, because it's a currency alternative and it's a financial system alternative, which has withstood the test of time. The reason we drop gold is because we don't feel like we have a perceivable edge in it, right? I feel like people, a lot of people have gold in their portfolios. Like I cannot justify charging you for something where I have negative alpha. And so we do have a very modest amount of alpha, but like you could get that doing any number of like well-established techniques. And so when we look at gold, what we see is the characteristics are just odd relative to, other commodities and stuff. Gold markets are persistently in contango. They have very odd autocorrelation characteristics. They tend to be moved by central bank. So there are basically three big drivers of gold. The first big driver is actually like the thing that's hardest to quantify is just jewelry demand, global jewelry demand. Then the second is global central bank demand, which can be sporadic and really hard to predict as well. And then last, you may have the industrial applications of gold, but it's just between, the monetary properties of gold and the toughness of modeling the actual demand drivers in gold. Like our alpha in gold is relative to the rest of the commodity basket, where we have good amount of insight in the manufacturing economy, this, that, and whatnot, versus other assets. Like our alpha in gold is negative. On a standalone basis, maybe we can get you a 20 sharp ratio points or something from, trading gold and alpha. And we couldn't justify charging people for that.
Right.
So we just said, look, hold gold. You should do it. It's part of a beta portfolio. We can't charge you for it, but we can generate alpha on these other assets. That's what we're going to charge you for.
Yeah.
That's not for a lack of not trying.
Yeah, absolutely. I mean,
so do you want to finish off on the asset allocation slide?
yeah, sure. Why don't we? Yeah, it's right at the top, right?
Yeah. So you know what I love about this, first of all, before you just wanted to comment on it, because, if we started here, I think people would have said, oh, okay, 50-50 stocks and bonds. That makes perfect sense. Like I don't have to listen to the rest of this conversation. But, it's the complexity and it's easy, it's simple, but not easy, right? It's the complexity with which you reach this conclusion that I think is the valuable part of our conversation. It just happens to be 50-50 today, right?
Yeah.
Right at this moment in time. So, but with that, Aahan, please talk about the asset allocation.
Yeah, so the allocation, I think that's one of the things. So when I originally started Prometheus, we used to do like a 40 asset portfolio, and people loved it. It was really popular and all of that stuff. But it's really hard for a retail investor to turn over 40 assets every week. It's just it's cumbersome. It's not efficient. Like transaction costs, all those types of things. And so one of the things that we really focused on, we said it's like, okay, if we just focus on just the big beta pieces, right? So we have 3 ETFs in this portfolio. There's SPY, DBC, TLT. Can we capture all the major muscle movements, right? Can we just capture the big moves? And what we found is, do you have a reduction in performance for not having the additional 37 assets? Yeah. Is it that much? No. And so you can, a lot of people want to trade a tremendous number of assets and whatnot, but what we found is like when it comes to macro investing, you can get most of the benefits just trading a small basket of assets. It also allows us as research providers to have a tremendous amount of precision on those particular things, right? If you ask me to trade 10 countries, I can create models for 10 countries really easily. Will I know anything about the 10th country? Probably not. That's really the emphasis of having such a simple allocation. We've generally like our modeling expectations are basically, they're all, I'm sure Mike can attest to this, but they're relatively, they're strong. So we basically expect to be somewhere in the 0.7 to 0.9 kind of ratio, Sharpe ratio, kind of ballpark. The base allocation basically has a 0.4 to 0.6 range, depending on how you construct it. And then, we basically are trying to add, about 30 points of Sharpe ratio points on top of that. So we're trying to do is provide something very reasonable. So if you take a 10 vol, which is what this portfolio is going to try and do, every week it's going to set a 10% volatility. If you take a 10% volatility over a really long period of time, we want to generate an excess return over cash of 7 to 9%. That's basically the math you get to. So in today's environment, that could get you to double digits, which is, what we hope to achieve. We have actually, I don't want to talk too much about that, but we have achieved that over our actual live track. So that's been great. But, when we look at this allocation today, basically we're basically reflecting all the things that we talked. We're slowly reducing our stock exposure, slowly increasing our bond exposure. And the combined allocation is always just trying to get to us a constant 10% vol target, which we think is responsible for most people.
And
it's that dimmer switch that you're referring to right there as well. Not so much on and off. It could probably have changes if you get those sort of monumental regime shift days where you're going to have slightly larger changes, and it's got to reflect the ability for the end user to actually capture all of the returns, or that risk-adjusted return, via executing it rather in their own domains to do so. So when you're talking about, the retail investor and retail investors and trying to democratize the process, get their heads wrapped around, a 10% volatility as a target, not letting not letting the maniacs run the asylum, but actually, looking at the portfolio, forming a portfolio of assets in that 10 vol range, you get a tremendous amount of benefit from the risk reduction. Right. A lot of that increase in Sharpe ratio comes from not having those outlier drawdowns, which has an additional benefit for investors who are using the portfolio to fund lifestyle obligations, not having those volatility gremlins eat away so much from your income that you might be garnering from the portfolio by keeping that volatility well managed. And so I think you've come to a place where you've got a really good balance. Hey, this is easy to execute. 10 ETFs, right? Now you're talking about rebalancing across 10 ETFs. You actually would have to use a spreadsheet of some kind, and that sort of you just get a fall off of execution to be able to deliver what the end client wants, and you're not getting much of a bump to overcome the noise and changes that will be there. There'll be more of those. And then there's the actual execution by the individual investor that has to be done. Right? If it's missed or if it's miscalculated, lots of challenges there. So keeping it really simple, and yes, 4 assets, 4 big muscle movements like this can really navigate across those in markets like disinflationary growth, inflationary growth, stagflation, all of those environments and the liquidity layers that come on top. You can really well manage that, come up with a portfolio, especially when you include cash as well. Cash is not an asset that yields zero anymore. That's another thing people, I think, are slowly learning again. Cash and bonds don't yield zero now. They actually have meaningful contributions, meaningful carry to contribute to a portfolio. So there's a lot of, I wouldn't mistake the brilliance of the portfolio for the simplicity. I think part of the simplicity in this portfolio for investors is its brilliance. And so I will just underline that as well. Behind that,
it's eloquent.
Probably circled the drain a lot in order to come to that conclusion and have the learnings as we did too, the slings and arrows of, sure, 10 assets is going to be slightly better after costs, after execution, after the person who's doing the execution makes the mistakes of not doing the execution or loses the discipline because it's too complex. It doesn't work as well as just keeping it really simple and staying in tune with the more value add sort of prognostications of where price is going to be.
I love it. It's eloquent. It's an elegant solution. It meets investors where they are, and easy to follow. And you've actually succeeded, I think, in doing this way. You've actually succeeded, as Mike aptly pointed out. Making the complicated easy.
Thank you both so much.
Yeah, we've been talking to Aahan Menon. from Prometheus. Aahan, thank you so much for your incredibly valuable time. I don't know if you have any parting thoughts you wanted to share before we cap off this discussion, but it's been amazing to have you.
Likewise, no thoughts in particular. It's just a big thank you for having me on. It's been a real pleasure to chat with you guys as always.
Likewise.
Thanks, Aahan.